On this, the morning that Lehman Brothers has filed for bankruptcy, the big question is how serious is this financial crisis becoming? I think it's without doubt the worst financial crisis of my working life, covering financial affairs for over 40 years. And the thing about it is it's not confined to either the US, the fallout is apparent in Europe. It's not confined just to investment banking. There is growing concern about regional banks in the United States, and it's also creeping into insurance with concerns about AIG, the big insurer, which has a big position in the credit insurance markets. Now, the interesting question, apart from that, is why is it that the US Treasury, why is it that the US authorities have been prepared to allow Lehman Brothers to go to the wall when they didn't do that with another smaller investment bank, Bear Stearns? Well, I think there are two things you can say. First of all, Bear Stearns was not allowed to go to the wall at a time when the Fed was not providing liquidity support to investment banks. Today, the investment banks can go to the Fed for overnight liquidity if they are in trouble. At the same time, I think it's part of Hank Paulson, the US Treasury Secretary's calculation that everybody has seen the problems of Lehman Brothers coming from a long way off and should have been able to cover themselves against these risks. Therefore, it was a fair risk on the part of the US Treasury to let Lehman Brothers go. Now, time will tell, because Lehman Brothers is pretty big and the whole financial system is pretty rocky. And at the same time, everybody now will be asking about contagion. What will happen henceforth to Morgan Stanley, another independent investment bank? What about Goldman Sachs? Quite apart from the worries that people have about AIG in insurance and also about Washington Mutual, which is in many people's sights. But I think probably we're witnessing the death knell of the independent investment bank. And I think that if you look more widely around the banking system too, it seems to me that the regulatory response to this crisis will be to impose much more swingeing capital adequacy requirements on banks, such that we will end up with a banking system that looks much more like the kind of utility type banking system that we had in the 1950s and the 1960s. A low-risk banking system, a banking system with relatively low profitability. The only thing about that, though, is that I think we will find that in a low-risk banking system, a lot of those very clever, ambitious people, the investment bankers, will jump ship. They'll go off to a new shadow banking system, probably among the hedge funds, and the risk is that there they will engage in activities which will build these institutions up into something that's too big to fail, and we'll be back in the same position all over again. So why, you might ask, do these financial crises recur? Why is it time and again that these things happen? And I think the real answer, that the most important answer, has to be moral hazard. That is to say, if you bail out financial institutions time and time again, risk appetite in the system increases. People assume there is a safety net, and then they will misbehave in such a way that risk will build up and further bailouts will be demanded. What is brave about what we have seen over this past weekend on the part of the US Treasury is that they're trying to address precisely that problem. If this works, it will be a huge step in a helpful direction in terms of thinking about the future stability of the financial system.